exactly.
Yeah.
So you only need 90 points. So welcome to session 1, Insurance Basics. Thank you for being here and sharing your time in your afternoon with us. And yeah, I just want to commend you for showing up. I think that's the first thing that helps, sets you apart from everybody else, is that you're investing your time and energy to attend one of these types of sessions to help you with preparing for the exam. I'm going to move the camera further because I'm going to write on the Post-it, all right? So you tell me if it's, if I need to do it. Let's see. How's that?
That's pretty good.
Yeah, okay, it's kind of crooked, but.
No, it's pretty good, Ron.
Okay, good. All right, great. So, so like I said, you know, our goal is to cover the essence and the pieces that'll matter the most on your exam, for your exam. And a quick review from yesterday, right? There's 3 basic learning styles. It's visual, auditory, and kinesthetic. So the visual you're going to see, and one of the other things I recommended that you have with you is that you take notes while I'm covering the material, that you have crayons or markers or colors, anything that you can write with that will help some of the material stand out for you. And the reason why you use color in the notes and don't just like focus on black and white on the page is because color will help stimulate the visual cortex, which will help you with memory retention. So let's say, for example, like right now, you don't have your markers or colors or whatever, you don't have any color to add to your notes, then take it in your pen and paper, and then later grab your markers and have some fun with it. Draw some additional pictures, circle things, go back and you review your notes within an hour after we cover the material here. So we'll the next, 2 hours, I think we're scheduled from 1:30 to 3:30. So for the next couple hours, I'm going to share some information with you. Again, the color thing, if you don't have it with you right now, then, you know, do it afterwards and just review your material and within an hour after we cover the material. And I usually say an hour because, you know, life will take your attention and we have a 2-day pause in between where you have your homework. And I want to make sure that this material sinks in because, like I said, we're going to probably cover about 25 points that you're likely to see on the exam. Now, we're going to cover more than 25 points. It's just that we don't know which 25 points they're going to ask you on in regards to chapters 1 and chapter 2. The other thing that I want to let you know is that I also interject some code and ethics into all of this. And sometimes I'll make the distinction and sometimes I won't. But we're going to start at the very beginning with just some basic terminology and some basic words. And I'm going to turn the light on because I look a little bit dark on the screen. So just give me a moment, okay? All right. So unless you have some background noise, I encourage you to unmute yourself. And that way you can answer the questions that I ask. I encourage you to answer them out loud. That's the auditory piece of learning, right? So it lands on you one way when you hear me say it. But when you say it and you repeat after me or you answer my question out loud, I already know as a trainer that you already have this internal dialogue going on because you're like, when are we going to get started with this stuff, right? Always internal dialogue. That internal dialogue is either going to empower you or disempower you. And so in the classroom, we want to guide that internal dialogue. So as I'm covering the material, if I ask a question, I encourage you to respond out loud. It looks like all of you are all by yourself. There's nobody else around. So, you know, say it in any way that you want. And again, to reinforce the learning and tapping into another part of the brain by using the auditory piece when you say it. Because when you say it, it actually means so much more than when I say it. Because we are always in this internal dialogue and always listening to ourselves. And then the other piece is the kinesthetic, which I encourage you to write things down. We're going to be in a 2-hour session, so there will be a moment in between where I'm going to have you stand up. Yes, I will have you stand up and stretch. And why we will do that is because, one, it adds that kinesthetic component to it, and then it also allows for you know, the circulation of the blood and all of the things that we need our body to have more energy, right? Because when the body's stagnant, then the energy's stagnant. So at some point, if I notice that you guys might get a little fussy, then we might do it before an hour. But you can count on the hour mark. We'll usually take a little stand-up break. We'll stretch a little bit. You know, as the week progresses, if you guys are interested in it, I'll add a little bit of like alignment-based yoga into it. We'll just do like a 2 to 3 minute little stretch inside of it. You know, part of my yoga teacher training is alignment-based hatha yoga, And so when the body's aligned, you're in a much better place to make better choices, and you feel more in alignment and congruent with yourself as well. So you'll get a little bonus in this class with me, all right? So let's get started. Any questions so far?
Nope.
No? Okay, great. So we're gonna start with this person over here. And this person's pretty happy. Why? Because we're gonna call them the Insured Ed. So this person's name is Ed. And I wanna make the distinction of Insured Ed versus, can you see that?
Mm-hmm. Yes.
I wanna make the distinction between Insured Ed and Insurer. And the Insurer, who is the Insurer?
The company.
That's right. So the Insurer is the insurance company. So if you've seen some of our videos, if you've seen our live Facebook, I've covered this material there. I will be more specific as far as, you'll see a question something like this, right? So because this isn't live, I can edit certain things out, so this is a good thing. So the Insurer is the insurance company, and we say Insurer. And the reason we say Insurer is to make that distinction, because when you take your exam, there is a possibility where you could get a question that asks you, what will the Insured pay? What will the Insurer pay? And there's a difference between what the company will pay and what the client will pay. And you want to make sure that you make that distinction. So the Insured, that's Ed, is the who? Who is the Insured? We would define them as the what?
The client.
Okay, the client. We might call them the policy owner.
The member.
The member. Okay, who said member? Was that you?
Caneva.
Yeah, Caneva. Are you on the employee benefits world? Is that where you're from?
Yes.
That's why you said member. Awesome. So we can call them the member. What else might we call them? So I'm going to give you the test answer for this. Are you ready?
Mm-hmm.
So the test answer is the object of insurance. Meaning they're the person being protected, right? So the Insured is the object of insurance. However, all of these other answers are true as well, right? There's more than one way to refer to the client. You can call them the policy owner, you can call them the Insured, the person being protected. You may even call them the member, right, in group insurance, where the employee is a group member, and so then they would be covered under the plan. Now, in an employer-based plan, who is the policy owner?
Wouldn't it be the employer?
It is the employer. So in a group plan, you have the employer is the master policy owner, and then you have the insured, the people who are being protected, as the employees who are the members of the group. In the individual market, we have the policy owner. In life insurance, the policy owner and the insured may be the same person, or they can be two different people, right? It just depends. So for example, Rebecca, do you have any children?
Yes.
Okay, so how many kids do you have?
2 children.
So Rebecca, actually, you know what? I'm going to refrain from asking personal questions like that, because we're going to put this online. And so I'm going to make up stories for all of you. I'm going to make up whether you're married or divorced or whatever it is. And so let's say Rebecca has 5 kids. Oh no, that's a lot of kids. So Rebecca is the policy owner, and she decides to buy life insurance on every child, 5 kids. So she would be the policy owner, and each child would be the Insured. Now, can Rebecca buy a policy on herself? Absolutely, right? If she bought a policy on herself, or even if any of you bought a policy on yourself, you would be both what? The
Policy owner.
Policy owner and the
Insured.
Insured and the Insured. And the same is true for health insurance. It's a little bit different, right? Because the insured is generally the person buying the policy. You don't usually have people buying health insurance policy on someone else unless it's a group policy where the employer is purchasing the policy, or if you have if you have a family plan, right? The family plan is one policy that covers all family members. Whereas in the individual market, you're just buying the policy for yourself, right? Because once you add another person to the coverage, it's no longer an individual policy, it becomes a family policy. Now, I want to make a distinction here that doesn't fall under the insurance basics, but a family policy and a group policy are not the same. A family policy is one contract that covers all family members, right? And you pay a premium for the family. When you have group insurance, you actually have group sponsor and group members. The group sponsor has the master policy, and then each of the members get what? You all are familiar. If you've ever had employer-based health insurance plans, what do they give you to show that you have insurance?
An insurance card.
Yeah, your insurance card, which is like a certificate of insurance.
Yeah,
Right?
certificate. Mm-hmm.
Right. So remember, that's like 2 points there outside of, falls under the category of group insurance, where the employer gets the master policy. And actually, I'm going to put it over here on the side. When I go off subject and give you more points for your exam, I'm going to put it on the whiteboard, okay? So with group insurance, who is the master policy owner?
The
Who gets the
employer.
master policy? The
The
employer.
employer.
Right. Oh, I don't want to use that pen. Hold on a second. And ER is for employer. And then what do the employees get?
Certificate of insurance.
They get certificates of insurance. And these are basically the key words. If they're asking you something about the master policy, they're usually talking about group insurance, and that goes to the employer. If they're asking about who gets certificates, they're talking about the employees, and that's under group insurance. Because group insurance is usually, for the purpose of the test and for the purpose of the class, we always, and I don't like to use the word always, but we always use the employer-employee group as an example. So the employer-employee group is the most common type of group insurance. Are there other types of groups other than the employer-employee group? Yes. There's like unions, right? There's associations. So there's other types of groups other than the employer-employee group, but that's the thing that we focus the most attention on for the exam. Now,
It's the same as an insurance card.
yes, exactly. It's the equivalent to that. They won't ask you, like on the exam, they're not going to say insurance card. They're going to call it certificates. The members of the group get certificates of insurance.
And can we go back to your previous example of the mother with the 5 children?
Yes, that would be for life insurance. So that would be an individual plan.
Yes,
the individual market. Say again?
Yes, but the question is, would the mom be the policy owner and the children be the insured,
That is correct.
but not the mother?
The mother's only the policy owner. So she controls everything around that policy. So let's say, for example, you bought a policy, and I don't know what kind of kids you have, but I'm just going to say you have your son, you buy a policy on your son, and let's say that your son comes to you and says, hey, Mom, I need help with the down payment on a home. You own the cash value policy on your son's life. You can borrow against the cash value. But does your son have permission to borrow from the cash value? No. Why? They're not the policy owner. So see, the biggest distinction between the policy owner and the insured is that the policy owner has ownership rights. The policy owner has ownership rights that the insured does not have. In the section where we talk about policy provisions, I think it's session number 4, we're going to cover like what are those policy options, and those policy options include the right to cancel the policy. You get to choose the beneficiary, so you're going to choose who receives the payout when the insured dies, right? So the policy owner owns the policy, pays the premium generally, and then the insured is the person who dies in order for the death benefit to be paid out in the life insurance policy. So far, so good? Yes? Okay, good. All right, so then the insured or policy owner pays what to the insurer? What are they paying to the insurer? What do we call
A premium
Yes, they pay the premium.
or consideration.
Or consideration. Who was that, my sporty pants over there? It's all good. I'm glad to hear that because you're taking your test. What, is it next week?
Yes.
Yes, awesome. Okay, so the insured pays a premium, and in exchange for the premium, what is the insured getting for that? What is the insured getting?
Indemnity.
Okay, so I'll put that in there. So they're getting indemnified.
Mm-hmm. They're transferring the risk.
All right, you're getting ahead of me now.
Oh.
But hold that thought, hold that thought.
Okay.
So what is the insured getting back when they pay this premium? What are you getting back? When you buy insurance, what do you get out of buying insurance? What do you get out of buying insurance? Vicki, you can participate too.
You get coverage.
Okay, so you get coverage. What else are you getting? So now, so you have auto, and this is true for any insurance, right? Like, you know, you have auto insurance. So when you go out in your car and you're driving around, knowing that you have auto insurance, what does that provide you?
A sense of security.
Okay, I love that. Okay, that's textbook answer, right? Sense of
Mhm.
security. If I have security, then I probably have some peace of mind. That's another textbook answer.
Mhm.
And when you're looking at the mechanism of insurance, the exchange of paying the premium and what the insured is getting back is a promise.
Oh, a promise.
Yes, it's a promise. So all of those things are true, but in the mechanism of insurance, this trade-off is that you're paying the premium in exchange for the promise. Knowing that this is a promise, this exchange is a promise is key because it has an effect on everything else that we talk about. Understanding that piece of it will help you when we talk about contract law, because in contract law, insurance contracts are unilateral contracts. And the definition of a unilateral contract is the exchange of an act, which is the act of paying the premium, for a promise. And uni meaning one, lateral sided, so the contract is one-sided, meaning that only one party must live up to their part of the agreement. And which party is that? The person who makes the what?
The promise.
The promise, exactly, the promise. Now, if I fail to pay my premium as the policy owner or as the insured, does that mean that the insurance company can come back and sue me for not paying the premium?
No, they
No.
just don't cover you.
Exactly. They're relieved of any liability and they don't have to fulfill on their promise. Now, a key that's important in this mechanism is this promise, right? See, I'm going to step out a little bit and add the code and ethics component to it. And I think this is really important, especially right now for people to understand. Like insurance companies are doing a lot right now during the COVID-19, right? Might as well address what's in the room and why we're here live on Zoom right now, right? It's because things are changing. Everybody's at home right now. People are transitioning, trying to figure out what they're going to do. But in the meanwhile, there's commercials out there, right? This is what I love about the insurance industry. Yes, I drank the Kool-Aid. I think the insurance industry, it's the foundation of every sound financial plan. It's the security, it's protection. Because see, check this out. The insurance company's promise is only as good as their financial strength. So the insurer's promise is only as good as their financial strength. And how their financial strength is measured. Now, I want to remind you, we cover a mile wide worth of material and we only go an inch deep. So we're only dealing with the surface of what the mechanism of insurance is. We're not really diving deep into what it's all about. We're just getting the surface pieces of what you need to know, which is really the basics and how it works. And see, the financial strength is important because that's how they fulfill on their promise, right? They need to have the financial means to be able to fulfill on their promise. And this is how it works. We're primarily regulated at what level? We're regulated, can you guys see that?
By state?
Yes, at the state level. So in California, we have the insurance commissioner. And I can call our commissioner a he because he is a he, Commissioner Lara. And he basically, you know, he helps enforce the laws and the rules and regulations of the California Insurance Code. That is his job. And he is elected. How is he selected?
By the people?
Right, and he's elected. So if you see a question that goes exactly what I just asked, how is the commissioner selected? Check it out, the answers in the question. This is so cool. He is what?
Elected.
Elected. Isn't that cool? By the people, just like you said. Exactly. So the Department of Insurance regulates, and see, the insurance industry is regulated on a state-to-state basis. So we are primarily regulated on a state-to-state basis. Again, I'm going to go off a little bit over here, but we're regulated. Let me grab my pens here. I don't have red, so we're going to use this color instead. Which is close enough, right?
It looks red.
So it looks red, good. And then we have this level. And then we have this level. So there's 3 levels of regulation in the insurance. Let's give this one a address. Okay. So what's this level? This is the
Federal.
federal regulation. Then we have
State.
state. And then we have self-regulation, where the industry regulates itself. You know, and I mean, people in the industry are very familiar with that. Before you can send any marketing material out, or before you can send any type of correspondence, it has to be pre-approved, because you don't want to alter what that promise is or mislead the client in any way to make them think that they may be covered when they're not. I think we have somebody else joining us. Just a second. Okay. All right, any questions about these 3 levels of regulations? So again,
Nope.
just give me a couple days to figure out this Zoom thing, and I'll have fewer distractions. The other Zoom sessions I've been doing are they were webinars, and webinars are one-sided. And I have to tell you, I enjoy this so much more, that I'm able to see your face and get that interaction, and then notice if I need to go into more depth with the material. So this is awesome for me. I'm so much more happier than the last couple of weeks doing these sessions. So getting back to these 3 levels of regulation. So we're primarily regulated like at the state level. This is our primary level of regulation. So when you get your license here in California, you're going to get what's called a resident license. Can you transact in other states with this resident license? Yes or no? 50-50 chance. No.
No.
It's because we're primarily regulated on the state level, right? If you want to transact in another state, you can get a non-resident license in those states, and it's really, really easy. I actually have a client who has employees in Hawaii. And so in order to earn the business in California, guess what? I had to get licensed in Hawaii. And I can't tell you how quick it was for me to get my non-resident license in Hawaii. It literally took like a matter of 3 days for that to happen. And so, and this is true for like almost any other state. You go to other states, you simply go to this one website, and you can get licensed in multiple states at the same time if you have business to write in those other states. So once you have a California resident license, and you want to transact in another state, then you can get a non-resident license in those other states. And it's pretty simple. California has some pretty strict licensing requirements, and because of that, it makes it easier to get licensed in other states, all right? So why is this so important? Because in order to transact in the state of California, every insurer has to get approved. And they're going to look at the financial strength of the company. Of course, they're going to look at the finances of the company to see if they're eligible for what we call a certificate of authority. The certificate of authority gives the insurer the authority to transact in the state of California. Pineva, right?
Geneva, yes.
Pineva. What do we call an insurer that is authorized to transact in the state of California? What do we call them?
An admitted insurer?
Say it like you mean it.
Carrier?
What are they?
An admitted.
They're an admitted insurer, exactly. With certainty, you know this stuff. I'm surprised. You're very well prepared.
Well, yeah, I've been studying for a whole week.
Awesome. So if you're approved in the state, you're called an admitted insurer. If you're not approved in the state, then we call them a non-admitted insurer. Now, what do they look at for financial strength? In order for a company to be considered solvent, to be considered what?
Solvent.
Solvent. They must have enough capital, surplus, and reserves. So they must have enough capital, surplus, and reserves. Capital is like the money that they have, right, that they're working with. That's the capital. Then you have surplus. What's surplus? Surplus is?
An amount over and above the policies.
Yeah, so it's extra, right? Surplus is extra. It's excess. Everybody likes surplus, right? I mean, I like to say, for some reason, I always look at surplus and my head says Slurpees. I don't know why. So everybody likes to have extra Slurpees, right? So surplus is extra. And then reserves are the money set aside to pay claims. So they have to have enough money set aside to pay claims. So the way that that works, I'm going to talk about reserves right now. When the insured pays the premium and the insurance company collects the premium, they're going to take a portion of that premium and set it aside. And they're going to pull all of those premium dollars together from all of the policyholders. They pull all of those premiums together. And every dollar sign here represents a policyholder. And when one of those policyholders suffers a loss, what happens? We all share in that loss. because the insurance company is the mechanism for pulling all of the premiums together from all of these policyholders, so that when one person has a loss, then they're going to use those dollars that they've been holding to pay for that loss. And those monies that are set aside, what do we call those dollars again? We call them the
Reserve.
reserves. The reserves. Now, check this out. The insurance industry as a whole across the United States, not just in California, but across the US, right? The industry as a whole, how much money do you think they have in reserves? Just in reserves alone.
A lot.
Billion?
a lot, right? So I always like to, I like to introduce a little bit of like understanding where insurance fits in your financial plan, right? Because we have insurance. Insurance is all about risk management. It's all about protection. It's all about safety. And in times like this, people need certainty and they need some safety. Insurance is that mechanism that's underneath that if something happens, it's there to pick you up or to support you. See, we can create our own safety net with the insurance products that are available to us, or we can rely on the government safety net to support us. Which one do you think might be better?
Ours.
Our own, right? Having our own, right? There's a difference. Because in order to qualify for this other safety net over here with the government, those social programs, you have to meet certain needs. Over here on this side, though, we're creating our plan. So there's a planning process involved when we create our own safety net. And like right now, people are actually using their own mechanisms, right? People who are out of work, people who are not out of, people who are working are trying to figure out ways to minimize their costs because they don't know if they're going to keep their jobs. There's just a lot of uncertainty in play right now, right? These insurance products allow for that certainty to exist so that if you need that support, life insurance products, not that it's the first place you would go to if you needed some money, but certain life insurance products have an accumulation, a savings accumulation inside of it that you can borrow it and you can actually borrow against it and you don't even have to have a job. There's no credit check for that. Do you have to pay that loan back? We'll talk about this in session 3. Do you have to pay that loan back? No, because you're borrowing against the policy. But if you don't pay the loan back, it will come out of the death benefit when the insurer dies. Does that make sense?
Mhm.
There's also like health insurance, right? That's a big one. You have your auto insurance in case something happens. So again, these are the products that give you some certainty. Insurance is all about protection. Every sound financial plan has an element of insurance underneath it. A sound financial plan has some sort of insurance product underneath it all. Now, if we go to the opposite, what's the opposite of insurance? It's investment banking over here. Investment banking is all about what? Taking risk.
Yes.
The greater the risk, the greater
The game.
greater
Or
the
the
reward, the
loss.
greater the gain. So you have these two. Now, you might practice risk management, right? So I'm only going to risk so much. I'm only going to put so much into it. And then I might mitigate the risk and put money here and put money there. I'm managing the risk. But I'm aware that the bigger the risk, there's risk involved when you're investing in the stock market, right? We saw that. Like as soon as the COVID-19 people went into shelter in place, you know, we saw a huge drop in the stock market. All of the gains that we had since the Great Recession, we went below that. Now we're climbing back up and we're having more confidence in the economy and the stock market is above 20,000 again. I think it went below 20,000 for a brief moment. Now I think it's a 22 or 23. I don't sit and watch it every day, but I do know that, you know, people are gaining more confidence and we're seeing that, right? Because we're hoping and we're optimistic that the shelter in place is going to be lifted soon. So again, risk, we don't like to take risk. And then in the middle, we have banking. We've got insurance, investment banking, and banking. And all of these elements are regulated. And the insurance industry is the most regulated. Why? Because we are the foundation of the economy. There are literally not millions or billions of dollars that the insurance industry feeds into the economy, but there are literally trillions of dollars. I've read a couple years ago, I haven't checked the number, but I should, that there are over $29 trillion on reserve. So that's more than enough to pay off our deficit, right? But it's the foundation of everything that we do is insurance because it's there when we need it. And it gives you that sense of security. Someone said this. I said that, you know, textbook answer as to why people buy insurance is because it gives them peace of mind, right? You know that it's there when you need it. Now, I want to reiterate what I started talking about earlier. I think that it's great, like especially the auto companies. I think it's socially responsible of them. I really feel like I'm happy that the industry is seeing this, but they know that people are shelter in place. And so there's a number of companies that are actually giving you a discount or returning your premiums. I've seen the range between 15 to 25% of your auto premium is being returned to the policyholder, depending on the company. There's actually a list of companies out there that are actually like giving you a premium discount or returning the premiums that you paid. And I think that's amazing because, again, it's all about risk management. So if you're not out on the road, doesn't it make sense that they're going to give you a portion of the premium back? Now, I think it's silly for an individual to think that all of the premiums should be returned to them because guess what? They still need to put money where? In the reserves. Because when people get back out on the road, I'm telling you, I think they're going to be really excited to be out there. And who knows what's going to happen? Maybe we'll see like an influx of accidents. I don't want to, forecast this. But, we don't know what's going to happen when we get out of shelter in place. We're going to see more cars on the road. People haven't been driving for at least a month or two or a month and a half. And so who knows what's going to happen. But the fact that you're at home and they're returning a portion of the premiums, not all of them, I don't think people should expect all of it because we still have to protect for future losses. Does that make sense?
Yeah.
And this is all about like protection for now and protection for the future. So we're forecasting as if it was going to happen now, but also knowing it may not happen now, but it may happen in the future. And so we're always doing our planning for what if it happened today? What if something were to happen today? So reserves are money set aside to what? To pay
Claims.
And in the insurance companies, their ability to fulfill this promise is based on their financial strength, which we refer to as their solvency. When a company has the financial strength to pay their claims, we call them solvent. Now, I'm going to ask you a question that goes something like this. If the insurer only has enough, to pay, I'm going to run out of room, to pay outstanding. Now make room on your notes. I'm not going to write anymore because I want to leave room for the answer. But if the insurer only has enough to pay outstanding liability and reinsurance, so if the insurer only has enough to pay for outstanding liability and reinsurance, what do we call them?
Insolvent.
We call them insolvent. You just take your test now. We call them insolvent, right? And if they're insolvent, is there protection for the policyholder if the company goes insolvent? Yes. But it's limited, and you're not allowed to advertise this organization. You're giving the disclosure when you sell the products, but you're not advertising to the public. Now, we have an organization called the California Life and Health Insurance Guarantee Association. So CALIGA. So CALIGA stands for the California Life and Health Insurance Guarantee Association. You're prohibited from advertising it. Why? Because if an insurer were to go insolvent, it's not 100%. So let's say, for example, Vicky, here's Vicky, right? She has 3 policies. Let's just say she's got $1 million with the same insurance company. She's got $200,000, and then she has another policy that's like a smaller one that's $50,000. See, under CALIGA, if she has these policies with all of the same carrier and the company were to go belly up if they became insolvent, and there's a couple of things that would happen. Is first of all, if the insurer goes insolvent, who determines whether the company's insolvent? I put a heart when I make a mistake. You gotta love yourself through the mistakes, right? So here, let me rewrite it. If the company is determined insolvent, who determines that? Not the commissioner. The commissioner might flag a company that might be insolvent. It's actually up to the courts. So the courts determine whether or not the company is insolvent. So the commissioner would file with the courts whether or not a company is insolvent. If they are considered insolvent, there's one of 2 ways that this company will be handled. Either it will go into rehabilitation, where they're going to try to get the company back on its feet, rehabilitation, or it's going to go into liquidation.
So this is based on the reports that they give to the commissioner, or how do they get all this information or numbers?
Yes, so you guys mind if I take a sip? Just give me a moment.
That's fine.
I'm going to email you notes that I would normally give in the classroom. So one of the things that I'm doing if you're like investing your time and you're showing up to the live Zoom sessions, I'll give you notes and I'll give you quizzes, right?
Okay.
If you're like, if people are just doing this online because this is available on YouTube, I won't email them the information. So you're in a unique position where I send you these notes. So when I send you these notes over the weekend, these are the notes for the first 2 chapters. And there's a section, there's going to be a column and a box that you can ask questions about on Monday if you have any over the weekend. And in that box, it'll have like financial statements, like things that you need to know about financial statements and what they have to report. So how do we monitor this? How do we know this? Well, there are public companies out there that monitor the financial strength of the insurance company. An example of that is like AM Best. AM Best is the one that we most commonly use in the insurance industry. So if you want to see what the financial strength of your insurance company is, you can go to ambest.com and then you can type in the company and it'll tell you how that company is financially rated, whether it's an A company, A+ company, whatever rating system that they're using, right? You could always check. Moody's is another rating company. I think the S&P also has ratings. And so that's one way, right? The public monitors that. The other way is that the insurance companies, so the insurers are required to report their financials. Now, there's 2 different types of questions they can ask you related to that. Either how often do they report to the NAIC? The NAIC stands for the National Association of Insurance Commissioners. So the NAIC is an industry supported type of organization where it's the insurance commissioners. So it's an organization where the insurance commissioners all come together, they talk about like problems they have in their state regarding insurance issues, and then they come up with these model laws and solutions to address those issues. And then they bring their model laws back to the state, and then it's up to the state as to whether or not they want to adopt these model laws. And so the insurers are all required to be members of the NAIC, and they have to report their financial statements how often? Quarterly.
Okay.
So they're reporting their financial statements to the NAIC how often?
Quarterly.
Quarterly. And then to the California Department of Insurance, if they're an admitted carrier, how often are they reporting their financials to them?
Would it be annually or quarterly as well?
It is annually.
Annually?
It's annually. Now, on your licensing exam, you're either going to see NAIC, so if you're making clip notes, and you'll see this in the notes that I'm going to send you, NAIC equals quarterly. Now that's the best answer because you'll also see annually. That's true as well. So the insurers are actually submitting their statements to the insurer. I'm sorry, the insurers are submitting their statements to the NAIC, financial statements, quarterly and annually. The best answer is quarterly, and then the next answer would be quarterly and annually, right? The California Department of Insurance, how often are they sending their reports then? That would be annual. Yeah. And then there's another question regarding dividends. So we're going to talk about, I don't know if we're going to have enough time today, but I know in another Zoom call somewhere, I talked about the different types of insurance companies. You have a stock and you have a mutual. Now, a mutual company is where the policyholders get dividends. So I think 2 of you are with New York Life. So New York Life is a mutual company. So they pay policy dividends back to their policyholders. And those dividends have to be reported how often? How often are they reported?
Annually.
They're reported annually. They're reported annually. And that's kind of sexy. We'll talk about policy dividends in session 4 when we get to that point. I like talking about those. That's cool. So does that answer your question?
Yes.
Okay, good. I know if you ask me a question, I'm going to answer that question and then give you everything else you need to know related to that. You always get more.
I love
Unfortunately, the guys I date don't like it, but I'm always going to give you more. Like, are you in teacher mode? You know when that you know when the guy gives you that look, like I want a guy answer. Don't give me all the fluff. I don't know if I'm going to be able to edit that part out, but that's okay. So again, the guarantee association, if the insurer goes insolvent, who determines insolvency? It's the court system. They're either going to go into rehabilitation or liquidation. And we saw this when all of the banks, not all of the banks, but a lot of the banks were going bankrupt during the Great Recession, and they were going through this process. They were either being acquired by other companies or they were liquidating them, right? And it's one of 2 ways. They're either going to go through rehabilitation or liquidation, or they might go the long way. Maybe they thought they can rehabilitate the company and then they discover that they can't. Then they'll go into liquidation. Well, what happens to all of those policyholders that are filing a claim, right? Mm-hmm. Or the beneficiaries that are filing a claim during this liquidation? Well, the claim's going to go where? To the guarantee association. And this is why you're prohibited from advertising the Guarantee Association as a way to induce a client to buy a product from you, because it's not 100%. It's either 80% or what? 300,000. And they're only paying on a per person basis. So if we go back to this example over here with Vicky, Vicky has 3 policies with the same company. And if she passes, I hope you're not superstitious, but if she passes, right, and she's got to pay, the company has to pay a claim, how much are they going to pay out? How much will they pay? They're only going to pay the 300,000 because they're going to pay the lesser of the two. It's either 80% or 300,000, the lesser, and it's on a per person basis. So it's regardless of the number of policies you hold, they're only going to pay the lesser of the 80% or the 300,000. And then there's other stipulations for, like, if you have cash, if you have an annuity and how much cash is in the annuity, you don't need to know that specificity of it, but just be aware that the CALIGA, the California Life and Health Insurance Guarantee Association, the one for property and casualty, that's the California Insurance Guarantee Association. And I'm going to introduce this now. Anytime you see the word insurance, that pertains to property and casualty. So California Insurance Guarantee Association is going to be for your home, your auto, your business policies, commercial policies and such. And then your California Life and Health, right? You have the life and health in front of it. Then we're talking about life and health insurance products. So anytime you see the word like insurance, insurance agent, insurance broker, insurance solicitor, they are referring to what part of the industry?
Property and casualty.
Property and casualty to PNC. If they are talking about life and health, and it's going to be, you're going to see life insurance or health insurance. You're going to see those words in front of insurance, right? Which is really important because they'll ask you something like, the insurance agent has the authority to sell all of the following products except. So what can the insurance agent not sell?
Life?
Yes, life and health. Life and health. You need separate licensing to sell life insurance. You need a separate license for health insurance. So once you pass your life and health license, you'll have the authority to sell life insurance products and health insurance products. Can you sell auto insurance? No, you have to get a separate licensing for that. But your companies don't offer those products anyway, so it doesn't matter that you don't have the property and casualty product. But see, the general consumer, right, the average consumer, when they think of insurance, they think all insurance. And so it's really good practice to have these strategic partners of people who sell other insurance products, right? Because if I approach Rebecca and she's offering me a life insurance policy and I buy my life insurance and I get an annuity from her, but I say, hey, you know what, Rebecca, I really enjoy working with you. You know, can I get you to, can you do all my auto insurance as well? Well, hopefully she has these strategic partnerships that she can refer me to that's like her, because we like people who are like us, right? That's part of like rapport, and the people we hang out with are usually like us. And then I'll probably have a sense of like, oh, great, thank you, Rebecca, for that referral. I usually give 2 or 3 referrals. I don't give 1 referral because, you know, if you don't like that person, then, you know, at least you have 2 other opportunities, right, to see. So in this business, you definitely want to create those strategic partnerships so that you can give referrals to each other. It's just a little tip there. So any questions so far about the Guarantee Association and all of this fun stuff, right? Isn't this cool? I love this stuff. So great. All right. Let's go back to the first posting. We went off a little bit here. If the insurer only has enough to pay outstanding liability and reinsurance, see, if they only have enough, they're still considered insolvent. They have to have more than enough, right? Because if we go back to solvency, they have to have that surplus. They have to have what we call paid-in capital. It's not enough to have enough. People who had enough right before the COVID-19, right before the shelter in place, and they lost their job, guess what? They're waiting. They were very relieved to get the checks on Monday, weren't they? Because they're like, oh, thank goodness, because, you know, how am I going to pay my rent? How am I going to like feed my kids and feed my family? So again, you need to have more than enough. It's important to have that little slush fund or that slush account. And these products allow you to start planning. If you don't have somebody that, I always say, like, people don't generally go around saying, what's the most I can do to protect my financial house, right? It's not until somebody has a conversation with you, because we don't get taught this. And so in today's world, we need more and more of that today. We don't have financial literacy as the basis of our curriculum to teach our kids. It's not available unless it's sought out or they're being taught by their parents. So like, and I'm serious, if you have like teenagers or you know teenagers, that might be interested in this or be interested in like finance, this is a great place for them to start, to like watch these videos as we start talking about these different types of risks. Because if we go back to how, you know, Kneva, she jumped the gun a little bit when she said transfer of risk, right? Because the mechanism of insurance is exactly that, transfer of risk. Anytime you buy insurance, what you're doing is you're giving it to someone else. You're paying a premium in exchange for this protection in the future that may or may not happen, right? Because life is uncertain. Now, the cool thing is I describe it this way. Now, I oversimplify things. I'm not giving you any investment advice. I'm giving you education to put you in a better position to make some choices. And when it comes to risk management and it comes to insurance, I always say, are you willing to pay $20 now for $100 in the future? Now, that's not the exchange, but that's an exaggerated exchange of what I'm talking about. If I buy $1 million life insurance policy and I die, will the total premium equal $1 million? Yes or no? 50-50 chance.
Yes. No?
Never equal $1 million. Why buy it? Right?
Oh, yes, because you're not going to pay $1 million for it.
No, because the way the product works is I'm paying a little bit now. They're pulling all of the premium together, and there's people that are going to suffer a loss, and there are people that are not going to suffer a loss. See, but one of the unique characteristics of life insurance is that that is the only loss that is paid that is certain to happen. All other losses, all other types of insurance are based on some uncertain future event that may or may not happen. See, you buy auto insurance now, like, so I started driving way too young and I got in trouble, and but I got my license at 16. And then I got into my first car accident was in 1997, so I was 25 years old. So between 16 to 25, I paid my parents paid auto premiums and I paid auto premiums. Now, I got into 3 accidents in 1997 in an 8-month period. So do you think all of the premiums that were paid equal to the first claim was $11,000, the second was another $3,000, and then the third one was a little over $3,000. So that would be a total of like $17,000. Do you think that over the course of 16 to 25, I paid $17,000 in premium?
No.
No, not at all. So even if I put the money aside to try to self-insure, it wouldn't have accumulated to this amount that was lost, which I wouldn't even have known what that loss was going to be anyways. Does that make sense?
Mm-hmm.
So I always say, and again, oversimplifying it, you're paying $20 now for $100 in the future that may or may not happen. But life insurance is one of those products that will happen. You just don't know what. You don't know. You don't know what. What's the
You don't know when.
Yes, you don't know when. So there
Or
is some
how.
uncertainty. You just don't know when. But see, one of my favorite definitions of insurance is this. Insurance is a social device for spreading the loss among a large number of people. It's a social device. So what I love about that is that we all take care of each other, right? Because the insurance company is like the steward of all of the premiums. They are collecting the premiums, taking a portion of it, putting it aside in what account the reserves. And then when one person suffers a loss, all of our premiums are pulled together to pay for that loss. Now, of course, there's a cost associated with all of that, right? Because they have to assess the risk, they have to pay the people who sell the products, and yes, they make a ton of money, and, right, they're still taking risk. And they have to put extra money aside, so they're managing the risk, but they don't want to let everybody into the pool. Do we want everybody in the risk pool? Unfortunately not. There's one insurance product that regardless of your medical condition and your medical situation, they're allowed into the pool. And what product is that? Anybody? You should know this one.
Yeah, it's like a death health.
Your health insurance products.
Yeah. Oh, yeah.
Yeah.
I'm thinking too hard.
You're thinking too much.
Yeah. I'm like,
no thinking. No thinking. My goal is that you think less. So how many of you have heard of Obamacare? Who's heard of Obamacare? Yes?
Yes.
Obamacare? Yeah. So Obamacare is also known as, what's the formal name for Obamacare?
Oh, gosh.
No, it's not. Oh, my gosh.
It's ACA something.
Yeah. So it's the Patient Protection Affordable Care Act.
Uh-huh.
So I just got a notice that my battery on my laptop's low. So I'm going to still continue talking as I plug my laptop in. The formal name of Obamacare, we don't call it Obamacare. We call it the Patient Protection Affordable Care Act. And can you believe that it's been around for 10 years now? It's going to be 10 years since it's actually 10 years since President Obama signed the bill.
That's insane.
Pardon me?
That's insane.
Yeah, that it's been that long, right? Yeah, and the effects and the rippling effects of people still trying to fight it, right?
Mm-hmm.
So in 2014, when they passed the individual mandate, they also passed a law that prohibits health insurance companies from denying coverage due to pre-existing conditions. That's a really, really big deal. And I'm going to go out on a limb and say this, but the industry did that to itself. And the reason I say that it did that to itself is because they were denying people coverage for any pre-existing condition. And so you couldn't gain access to health insurance. Now, I'm not saying health care, because everybody's like the emergency room. If you really need it, you can go and they would take care of you. But the question is, who bears the cost? So we finance our health care through our health insurance premiums. And if you didn't have an employer-sponsored plan and you try to get coverage in the individual and family plan market, you better be really healthy, because the insurance companies didn't want to take you on as a risk. Because as an individual, you're supposed to be a much greater risk, because you're more inclined to buy it when you're
not doing well.
Right, when you're not doing well and you need it, right? And the purpose of insurance is not buying it when you need it. You're buying it, it's part of the planning process, and you're buying it in advance. And so the ACA came in and said, no, everyone is eligible, but you have to buy it during open enrollment. Now, currently, because under COVID-19 and because we don't have a federal penalty, we do have the federal mandate, but they repealed the federal penalty. The state of California last year passed a state penalty. So if you do not have health insurance in the state of California, when you file your state tax returns, you'll be subject to a state penalty. But they extended open enrollment so that you can still gain access to coverage until, it was the end of April, but I think they further extended it to the end of May. So people still have access to buying health insurance, which is very unusual, because usually open enrollment is November, December, and then California extended into January. So we usually have 3 months, right? But they've extended it because of our current conditions and situation. But that's the only insurance that they cannot deny coverage due to pre-existing conditions, right? That means that they're going to accept everybody. But all other types of insurance, they want the opportunity to assess the risk. And see, I think that we all know about risk, because the moment you're born, boom, guess what? You're born with risk. So we all have this inherent way of handling risk, don't you? And so I think I have to knit. Yeah, there we go. So since we have this inherent way of like managing risk, right? We all know that we're going to assess the risk. Insurance companies are master risk managers. Like, that's their job. They're not going to take a risk unless they know the numbers behind the risk. Hi, Brad. And so if in order to be allowed into the risk pool, what is the insurance company going to do? They're going to go through this process. What's that process called?
Vetting?
What is it called? Vetting. Okay, that's a good word for it. Yes, they're going to vet them. What's the word we're looking for specifically that's insurance related? Eva?
Oh my gosh, I'm drawing a blank.
You're so funny. I don't have room to write it down, but I'm going to tell you what it is. Underwriting.
Oh.
So underwriting is, it's okay. Underwriting is the process of evaluating, assessing, and classifying the risk. So not everybody's going to be allowed into the pool. They want to select the risk that they're willing to accept into the pool, right? And generally, the underwriter wants a large proportion of good risk versus a small proportion of bad risk. Now, will they accept, a high risk? Sure. But what happens if they accept that high risk? What will the company do to the premiums?
They will increase
It's
them.
higher.
They're going to increase the premiums, right? So they're going to charge a premium according to the risk factor. There's certain companies now, this is insurance basics, so we're going to speak both to life insurance, health insurance, and auto insurance and homeowners. And in auto insurance, there's certain companies that will, if you're a high risk driver, guess what? They're not going to insure you because they want a greater risk, right? Of good risk. They want good risk. And all of those bad risk, you can go somewhere else. So you can go to a company that writes substandard risk for auto insurance, but what happens to the policy, the premiums for that pool? It's going to be higher. Why? Because we have more high risk in the pool. But generally speaking, the insurance company wants a large pool because the larger the pool, the more predictable the losses. So they're using, remember I said the insurance companies, they're always managing the risk. They're always running the numbers on the risk. Can you imagine if we did that for every risk that we took, we sat there and we ran the numbers? I think we might go a little batty, but we might make different decisions, or we might try to find ways to mitigate those potential losses that we might face in the future. And so, but insurance companies, they don't have the convenience of waiting to experience a loss, because remember, they're the steward of the premium. They're the steward of the reserves, right? They're collecting the premium, setting a portion of it aside into what account again? The reserve account, right? To pay future claims. And they're using the law of large numbers. What are they using?
The law of large numbers.
Thank you, the law of large numbers, which is basically a mathematical rule that states the larger the pool, or the larger the number of like nature, the larger the number of like nature, the more accurate predict losses. I'm just going to shortcut it. Predict losses. And you want to add to it, predict the losses for the group. See, out of this risk pool, we don't know who that one person is that's going to suffer the loss. We just know the numbers. That if you have this number of like nature, this is the prediction of future losses for that like pool. That's why, and I keep emphasizing of like nature, because if we take a life insurance application and the person doesn't fall like within the norm of an acceptable risk, let's say, for example, let's say they're diabetic, or they have a heart condition, or they're in a hazardous occupation, they're not like everyone else. And those types of factors might pose a higher risk to the company, which might make them a higher risk, which will charge them, we will charge them, right? The insurer will charge them a higher premium, or they might not want to accept the risk at all. So again, there's an element of risk management from the insurance company in the underwriting process, right? The underwriting process is the evaluation of the risk to determine whether or not it's an acceptable risk. But like I said before, just because you want to buy insurance doesn't mean you're going to automatically, it may not be available to you, right? So there's a saying that I've heard several times before in life insurance. You buy your life insurance with your health and you pay with your premium. So you buy your life insurance with your health and you pay with your premium. Because one thing that's not guaranteed is what? Your health. We might be in the healthiest that we are now. And then 5 years later, you know, I don't know if you've experienced this, but I know in my 20s, you know, I could drink till like 2 o'clock in the morning and then teach class at 8 o'clock in the morning. If I tried to do that today, forget about it. You would know, right? Because we get older, our body doesn't handle things the same. And so, again, the younger you are, the lower the risk. The older you get, the higher the risk, and then we're predisposed to even more type of sicknesses and illnesses, right? And we're seeing this now. The media is talking about, you know, people who have underlying health conditions, and you know, we have more of the elders that are at high risk right now. Why? Because they're older and your body is not as efficient as it was when you were younger. So when's the best time to buy life insurance? Now, right? And then if you need health insurance, right, the best way to keep your premiums down or to take advantage of that is to, even though they don't look at health, you know, one of the things that's very unique about health insurance is that you have what we call cost sharing provisions. So when we get to Section 8, we'll talk about these cost sharing provisions like your deductibles and your co-pays and your co-insurance. If I stay healthy, I'm going to have fewer visits to the doctor. So what? I'm going to pay lesser of those. I won't be subject to cost sharing provisions. Why? Because I'm not going to the doctor. I'm keeping myself healthy. Does that make sense? So again, we're always managing the risk. Either it's the insurance company that's managing the risk or we're managing the risk for ourselves. Our role, though, as a health insurance agent, as an employee benefits consultant, whatever role or hat you're wearing and you're getting this license, you're always acting as the role of helping the client manage their risk, and more specifically the risk that you're offering protection for. See, the definition of risk, risk is defined, there's 3 definitions of risk, but it's all the same, right? Because risk is risk. So risk may be defined as the uncertainty of loss, the chance of loss, or the possibility of loss. And loss, what's the definition of a loss? Vicki, do you know the definition of a loss? No, how about Kineva?
Something that disappears.
You're such a good reader. So, a reduction in value or disappearance, right? A reduction in value or disappearance. So when you lose something, I don't like to define a word with the same word. But when you get into a car accident and there's damage to your car, doesn't that reduce the value of the car? If you get injured or hurt or sick, unfortunately, you're not able to go back to work, so you're going to see a reduction in your income. Or you may see a reduction in your ability to perform the duties that you would normally be able to perform if you didn't have this ailment, right? Disappearance, it's kind of weird to think of death as disappearing. It kind of adds a magic element to death, but they're disappeared, right? They're gone when somebody passes on. And so again, loss is a reduction in value or disappearance. And there's 3 principal types of losses. Yes, Rebecca, you have a question? Okay. So there's 3 principal types of losses. We have
Physical.
The physical has to do with hazards.
Oh.
So 3 principal types of losses include property, liability. And generally, when I put things in red like this and I'm separating things, we usually use property and casualty red, and then life and health will use blue. That's generally our colors for that. And so we have property, liability as 2 types of losses, and then we have human loss. And these are human losses resulting from death, disability, and then we add in here retirement or personnel. Somebody's no longer working, right? So if we look at the industry, we've got life insurance here, and under the life insurance umbrella, we offer 2 products that protect against human losses resulting from death or retirement or personnel. And that has to do with, if you live too long, what type of product do we offer? Anybody know? What product is designed to provide a lifetime stream of income?
Oh, long-term health insurance.
Long-term health pays for the costs related to
Whole
the
life
cost of care.
insurance. Is whole life insurance?
Annuities.
Oh.
Annuities are designed to pay, right, to provide a lifetime stream of income. Whereas life insurance is designed to pay if you die too soon. So life insurance and annuities are opposites of one another. Life insurance pays if you die too soon, whereas an annuity pays if you live too long. It's designed to provide a lifetime stream of income. That's the life piece, right? Human losses resulting from death or retirement or personnel. Now in the middle, we have human losses resulting from disability, where you have your health insurance policies that are ACA compliant. You have your long-term care policies that pay for the cost of care associated with the loss of 2 or more activities of daily living. And then you have like your medical supplemental plans, like your disability income, your critical illness policies, your accidental insurance, your accidental policies. All of those fall under, like in the employee benefits world, Kineva, we call that the ancillary benefits, right? And then if you go to this third arm over here, that is the property and liability, right? The other 2. So property and liability fall under the same category because under property and casualty insurance, they're going to provide protection against those physical and tangible things that you own, like your car, your bike, your wedding band, whatever it is that you want to insure, right? And then there's a liability component to it. And what's liability? Liability insurance is when it's what? When it's my fault. When it's my fault. So again, we have like these different parts of the industry, right? P&C is usually separate. You do have companies like State Farm and Farmers and Liberty Mutual. They offer all products, both life and P&C products, right? But they may not necessarily offer the accident and health products. So there's different aspects aspects, there's so many different paths in this industry, right? And then we go over here to the life. Life is protecting about the now in case something happens and you die too soon, and then protecting your future by providing a product that will provide you a lifetime stream of income when you're no longer working or you're in your income years. That's the design of the product, all right? So again, the three principal types of losses. So like I was saying, you're the risk manager for your client. You're helping them navigate through these risks. Now, the thing I want to be very clear is that for the purpose of the exam, you're wearing your insurance hat. So what that means is that when they ask you like all of the following are principal types of losses, except, because they like to ask you except questions, it's going to be financial loss. Now, oftentimes students like, oh, that doesn't make sense. Well, financial loss is how we measure it. The principal types of losses, we identify the potential for loss, and then we recommend insurance for that. So when we're looking at the principal types of losses, we're looking at it from the perspective of what type of insurance would protect that loss. And then how we measure that loss is through dollars. Because in order for a risk to be insurable, so in order for a risk to be insurable, I'm going to add that over here in this corner. There's 5 factors that are required for a risk to be insurable. And those factors include this. One is that they must be measurable. Well, if they have to be measurable, how are we going to measure that? It must be measurable. So how we measure it is what? Through our dollars. We measure it financially. What's the loss of income? So if this person dies too soon, what amount do we need to replace the loss of income upon this person's death to protect the family, right? You know, the car, like how much protection do I need? If I don't have a lot of stuff to protect, then maybe I can get a lower level of coverage. But if I have a lot of assets, the last thing I'm going to do is drive around with minimum coverage for my auto insurance. See, if I drive around with minimum coverage of, 15, 30, and 5,000 is property damage. I live in San Jose. Do you know what they like to drive down here? They love their what? Teslas. They love to drive their Teslas down here. So if I'm driving around with $5,000 worth of property damage and I hit a Tesla, who's going to be responsible for the loss above the 5,000?
You.
That's right, I am. So driving, again, you're the risk manager. So when somebody reveals to you that they own a house and they have a business, they're not going to be driving around with minimum financial responsibility because they have more at risk. Because the company will subrogate, the insurance company will subrogate for the amount that you were the cause of the loss. They will go after you for that and they'll subrogate that amount. They might pay the insured, but then they're going to seek you out for the remaining balance of the loss. Does that make sense? So it all goes back to risk management. So first of all, the loss must be measurable in order for it to be insurable. It must be uncertain, which we talked about earlier. The loss must result in an economic hardship. So the example of that would be this pen. Can I insure this pen? It's the color green, the color of the heart chakra. I love this pen. It's one of my favorite pens. Can I insure this pen? Yes or no? 50-50 chance.
No.
Rebecca says no. Why?
The value, it doesn't hold a high enough value to be insured.
It's not worth it, right? It's really not worth it. When you look at it, it's not worth it. Because the loss of this pen, I mean, it's a $5 pen. I mean, when you add shipping and handling for this one little pen, it's going to probably go up to $5. So with that being said, there's no loss of an economic hardship, so I wouldn't be able to insure this one pen. But if I have an inventory or a warehouse full of these pens and I sold these pens to like Hallmark and called them the Love Soulmate pens, can I insure the inventory held in the warehouse?
Yes.
Absolutely, because that would be a substantial loss. The last two are the law of large numbers, which we saw down here in this post-it, right? And then the other one is the exclusion of catastrophic perils. So they won't cover losses related to catastrophic perils, like acts of Mother Nature or God, tornado, flood, hurricanes, right? Earthquakes. Those types of perils are usually excluded from coverage. So if you wanted coverage for those types of perils, where would you go?
Hazard.
Pardon me?
I don't know what it's called. Hazard insurance?
Well, you'd actually go to the government. The government covers those types of perils. Like FEMA, right? They provide flood insurance. They would protect those types of losses. But
Right.
insurance companies, you'll generally find exclusions for those perils. So I didn't finish, did I start? Oh, right here. I didn't finish this piece up here. So uncertainty of loss, chance of loss, possibility of loss, all relates to risk. There's a question that says like all of the following define risk except or pertain to risk except, and then you're looking for cause of a loss. Because the cause of a loss is not a risk. The cause of a loss is peril. What is it?
Peril.
Peril. So like, fire is an example. Tornadoes. Floods. One of my favorites. What's this? Anybody know what this is? Where are the
Earthquake.
Earthquake, yes, earthquake. So another word for earthquake is massive land movement. So if there's a massive land movement, that would not only include earthquake, but that would include what? Landslides, would also include sinkholes. All of those different massive land movements are common exclusions found in your homeowner's insurance policy and your renter's policy.
So
If
the
you have-
Paradise,
Say again?
the Paradise Fire people in Paradise, California, who lost all their homes,
Yes.
the insurance companies are not helping them.
They're not helping them in what way?
Well, because the cause of loss was a fire. And so that risk is not included in the policy.
Well, usually when you buy homeowner's policy, it includes fire. I mean, that's why you buy it, to protect against fire. So they should, if they didn't have insurance, then I mean, that would be the problem. But I know there was a carrier in 2018, right? December 2018 that went insolvent, and they went insolvent because of the NorCal fires. And so I don't know if maybe they were insured by them. They probably would have covered a part of it through the what is it called? The Guarantee Association. But yeah, if you have homeowners fires, one of the perils that they actually do cover, it's part of your coverage.
Even if it was caused by an act of nature, a wildfire.
A wildfire, you have to read your policies, and that's like really important, is to read your policies. I know that there's, one of the questions that people ask me a lot is about the internet, like people buying their coverage on the internet. I'm not going to name any companies because we are going to put this online, but you got to find out the financial strength of the company, how long has the company been around, and you have to read your policy. And if you live in a high-risk area, find out if those perils are covered or not. And that's an important thing to consider. Most people don't read their policies. They trust their agent, or they go online and they buy their coverage. The disadvantage of going online and getting your coverage is that you don't have the benefit of an agent or somebody advising you to make sure that you have adequate coverage, and your coverage for the types of risks that might be related to the area that you live in. So, or at least shine light on the fact that, hey, you live on a fault line, or you live in a flood zone, so you may want to add additional coverage for those types of risks, or do things to mitigate the risk for those types of losses. So again, you're the risk manager, right? And so when you come in with a specialty in a certain type of insurance, then you got to be aware of what's covered and what's not covered. I won't go into too many storytelling because we don't have a lot of time here. I have 10 minutes left. Or wait, we're going till 3:30, is that right?
Yes, I believe so.
Oh, okay, cool, yeah. But I'm still not going to tell you the story because I have more to talk about. But we can certainly talk about it offline. But it is important to know the coverage that you buy as a consumer, to at least go in and review the policy. We have students who come through this class and don't even they might not get they might pass their exam and don't even file their application for a license. They decide, well, no, I'm going to do something else. And so in those situations, they just feel, one of the things that I get emails about is, hey, I decided not to get into the career, but I really appreciate what I learned in the classroom because I know what I'm looking for now when I look at the insurance products that I buy. I mean, people spend a lot of money on their policies. And I hate to admit this, I just switched my commercial policy last year and my premium doubled. And it doubled, and I didn't even bat an eyelash because I'm like, this is a very reputable company. I trust the agent. I know that I have more coverage than what I had before, and I know that my business is protected. And so now that I'm sharing this with you, I'm like, no, you know what? Regardless of the trust that I have with the agent, it's important that I still understand what I'm buying as a consumer, right? Especially if my premium doubled more than what I was paying before. Yes, the coverages went up, and what other perils am I covered, or maybe what's no longer covered that maybe I had coverage in the other policy. So yes, thank you for highlighting that, but you got to read your policy every time. Know what perils are protected and what is not. See, life and health is a little bit easier because in life and health insurance, we don't really care how you die. I'm sorry to say that. If you die, they pay, except, there's always exceptions, except if it's in the first 2 years of the issuance of the policy. See, in the first 2 years, we have what's called the Incontestable Clause. What's the name of the clause?
Incontestable.
Thank you, the Incontestable Clause. Within 2 years of the issuance of the policy, the insurance company literally has the right, because it's stated in the contract as the policy provision, that the insurer, I'll tell you what the clause reads. It prevents the insurer from using any misstatements or misrepresentation against the insured after the policy has been enforced for how many years?
2 years.
2 years. So it becomes incontestable after 2 years. So for any reason the insured lied on the application and death occurs in the first 2 years, and they have reason to believe that they didn't get all of the information when the application was submitted, they have the right to contest the claim. Now that doesn't mean they're going to contest it. They're just going to wonder, this person died too soon, right? From a risk management perspective, they're not going to issue policies to people who are going to die in the first 2 years. It doesn't make sense from a risk management perspective. It's important for the client to hold the policy for an extended period of time. Why? Because the greatest cost of issuing the life insurance product is in the first 2 years. They have to pay the agent's commission. They pay for all of the underwriting costs associated with the medical exam, getting your medical records. There's all this medical information that's required in order for the policy to be issued. So far, so good? So the longer you keep the policy, the persistency of keeping the policy is important. Does that make sense? All right. Let me see what else. So if they think that the insured, if they think that the person has some sort of medical condition that might preclude them from life insurance, then they're going to deny the coverage. They're not going to issue the policy. Does that make sense? 2 years. That's the magic number. So everybody go like this. 2. What letter is that?
2 years.
For voiding. It prevents the insurer from voiding. From what? Voiding. Another word for voiding is rescinding, canceling, or rescinding or canceling the policy after the policy has been in effect for how many years?
2 years.
2 years. Due to a material misrepresentation or I totally lost my train of thought. Can you remind me, Vicki?
I think it's time for a stretch then.
Oh my goodness, we didn't do our stretch. All right, yes. So you can sit in your chair or you can stand up, whatever you decide, whatever you want to do. If you're sitting down and you want to stay seated, then go ahead and put your feet flat on the ground. Just find yourself in a relaxed seated position and go ahead and inhale your hands up high to the sky. And then go ahead and stretch this way. Ugh, that feels so good. Inhale back up to the top. Exhale, go the other way.
Half moon
Inhale
pose.
back up to the top. Excuse me, I always yawn through that. Ugh. And then go to shake your hands out, shake your arms out. Go ahead and look to one side. Look forward again, look to the other side. We'll take a quick water break. How are you doing, Brad?
Trying to be present with everything going on.
Pardon me?
Said I'm trying to be present with everything else that's going on here. So.
Well, Brad, if you want to, I'm going to put this on YouTube later tonight. So if you want to, take a look at it later.
Yeah, I thought we were going to go till 3, so I was trying to get on to the next thing, and then just got a lot of plates spinning with all this transition going on.
Yeah, no, I totally get that. I can see that.
Yeah. So I'm going to stick through it as long as we can until my other call has to start. It'll probably go about 3:05, 3:10.
Okay, that's okay.
So,
And just take a look at just look at your email tonight. It'll probably send it like around the same time I did last night because I had to edit, so edit takes a little bit longer until I get used to doing that. I tried to talk my brother into doing it. He hasn't. I have to bribe him somehow.
I didn't get a copy of that last night.
Pardon me?
I didn't get a copy of that. I don't.
Yeah, you got an email last night. I even made sure I sent it to you.
I'll look.
Yeah, look in your spam because sometimes we go into spam. And I sent it from, I think I sent it from registration at quick-learn.com. So check there. Okay. Yeah, all right.
Well,
Thanks you're our stretch monitor, okay, Tanita?
Yeah, no problem. You're doing really good, Irma.
Oh, thank you. I like your picture. You look like you like to have fun.
Me?
Your
Never.
picture with all your friends.
Yeah, never.
I was at a virtual dance party last night on Zoom. It was kind of fun.
That's fun.
It was really fun. All right. So the last thing let's see, because my mind started to drift, right? So we're talking about peril. You mentioned the fires. And then what else? We're talking about the characteristics of an insurable risk, which is really important. And then we're going to move on to, we're talking about risk. Here it is. So just real quick, one of the questions that they might ask relates to like, all of the following pertain to risk except cause of a loss. Because you know, cause of a loss is a peril. Now, some other like keywords and terms you need to know related to loss include hazard. So a hazard is a condition. It's a condition that increases the likelihood of a loss. The likelihood of loss. Right. And hazards are important in assessing the risk, right? For example, you mentioned one of them, Kineba, you said physical, right?
Mm-hmm.
And then we also have moral and a morale hazard. So physical hazard is something that's tangible, right? Something that, like a broken chair is a physical hazard. If you have a broken arm or a broken leg, that's a physical hazard. So physical is anything that's structural, material, is a physical hazard. And of course, you know, if you have a broken leg, that would, you know, put you in a position where you could hurt yourself again, right? You don't have the same mobility if you had full use of both legs. So physical hazard. And then what's the other two is moral and morale. So moral has to do with what? Your values and habits. Morale with an E, we usually say like morale, like drinking and driving, right? So morale or morale with an E, that has to do with like carelessness,
Reckless.
yeah, reckless, carelessness, indifference, that's the word I was looking for. Yeah, you're kind of reckless, right? Indifference. But someone might say that drinking and driving is not a morale with an E hazard. They might say, no, that's a moral hazard. Well, what's the distinction between the two? What determines whether it's moral or morale? Because there is some gray area between the two, right? So the distinction is that a moral hazard, an example of that is dishonesty. And generally, dishonesty can be seen as intentional. So something that's done intentionally is a moral hazard. Something that's done like intentional, like you said, reckless, right? Like someone's just being reckless, they're not paying attention, they're not being attentive. We might refer to that as unintentional. So the first time someone gets in trouble and gets a DUI, all right, maybe that's intentional. We can see it as unintentional. But the second one, that's no longer unintentional. That looks now like a habit, right? That has a reflection of, that could be a reflection of your values. So then that is no longer an unintentional, it becomes intentional, and now it's a moral hazard. Are your habits and lifestyle important in the underwriting process? Yeah, of course, right? Because that'll determine your health. If somebody likes to, you know, if they're a smoker, if they are, you know, if they participate in some, you know, recreational 420 or something like that, right? That may have an effect on their health, right? Or not, I don't know. They say that it helps, you know, like with stress. That's what I heard. So again, so you have these different types of hazards that, of course, in the underwriting process, the insurance company is going to want to look at and be aware of. Then moving on from hazard, we talked about peril and risk. And one of the things that I mentioned earlier is that insurance companies are master risk managers. So one of the last things we're going to talk about today is risk management. Risk management. And we have an acronym that we use to help you remember how to manage a risk. And we use STAR, R. I say RR because there's two R's in R star. So we have S, T, A, R. So one of the ways that we use, right, in managing a risk, and that the method that we want our clients to use when managing a risk is that we want them to transfer the risk. What do we want them to do?
Transfer the risk.
Thank you. We want them to give the risk to someone else, and preferably to who? To the insurer, to us, right? And generally, obviously, when you transfer the risk to someone else, there's usually a cost associated with that. You're paying a premium in exchange for that protection, right? So that's the transfer risk. Now, regardless of the tense of the word that I use, whether it's the version of the word, if I use transfer, transferring, it's all the same. Avoid, avoidance, avoiding, it's all the same. And it just, you want to look at like who's managing the risk. So to transfer the risk means I'm giving it to someone else. And sometimes it makes sense to buy insurance, doesn't it? Most of the time, like, oh, we want them to buy insurance, but sometimes it doesn't make sense to buy insurance for it. Maybe we may want to avoid the risk. So we might go through risk avoidance, loss avoidance. For example, we don't get the swimming pool in the backyard. By not getting the swimming pool in the backyard, nobody will drown in our backyard. Now, there's a question that we have in one of our quizzes that has to do with the pet tiger. Returning the pet tiger to the zoo. Okay, that is not the right answer. I don't know why the answer looks so sexy to people, but they answer it, and it's wrong. So no tigers. Tigers is not the right answer. Something like accept, right? They love to accept questions on the exam. So all the following are ways to avoid a risk except, okay, it is not the pet tiger. It's buying more insurance. Because anytime you buy insurance, what method of managing a risk are you using? What are you using?
Transfer.
Transfer. Thank you. You're transferring the risk. So anytime you buy insurance, and that's the example, they might ask you, there's like 2 or 3 different versions of the question. All of the following ways are a way to avoid the risk. All of the following are a way to reduce the risk. And the exception each time is going to be buying more insurance. Because when you buy insurance, it's transferring the risk. It's transferring the risk. The next one, what's the next method of managing a risk? Is risk or loss reduction. So how does someone reduce the risk of getting into a car accident? How do we reduce that? How do we reduce the risk of getting into a car accident? What do we do?
Don't
Get
speed.
it.
What do we do? Don't
We
speed.
drive safe.
Drive safe. Okay.
Don't drive.
Don't drive.
Wear your
Would
seatbelt.
that be avoiding the risk? If I don't drive, that might be avoiding the risk. But driving, I don't know if not speeding is way to reduce the risk, Rebecca, because I don't know, like if you go the speed limit, that you might be a higher risk.
Yeah, depending on if it's right. If it's right when we get out of COVID, or
I don't know how people are going to drive once we get out of this thing. That's going to be really interesting to see what happens with those losses, right?
yeah,
But like checking your tires, right? Check for balding tires, checking your brakes. You know, how do you reduce the risk of a house fire? You know, you check for like the electrical outlets and exposed wires. You may even like want to go outside and make sure that there's a fair distance, right, between your home and, you know, any type of a brush area. There's certain things that you can do to help reduce or mitigate the losses related to a fire or to getting into a car accident. In life insurance, how do we reduce the risk of dying?
Stay healthy.
Stay healthy, right? I'm reading all these things, like I got this reishi mushroom tea thing, and then all of a sudden I got a sore throat, and I'm like, oh no, I thought this was supposed to be antiviral. You know, living a healthier lifestyle, right, would not only help reduce the risk of dying, but also keep you healthy, right?
exercise and diet.
Exercising, diet, watching what you eat. What else? So if you have a swimming pool, I have to bring the swimming pool back in. So we know to avoid the risk of somebody drowning, right? We don't get the swimming pool, but what's the way to reduce the chances of somebody, you know, drowning in our pool? What would we do? We would get a
Fence.
You'd get a fence. And then
I
I
was
always
gonna
say
say lifeguard.
a lifeguard, 24/7 lifeguard. Geneva has like her own little private lifeguard that's waiting outside for her. And then one way to transfer the risk of the swimming pool is you get your neighbor to buy the swimming pool. They have a swimming pool, right? Now the next one is risk retention, loss retention. This one's an interesting one, loss retention. And the reason I say it's interesting because this has to do with, sometimes there's risk that you're not going to insure. There's risk that you're not going to reduce or you're not going to avoid. So let me ask you this. How many of you have cell phone insurance? Who has cell phone insurance? Brad and I are, okay, Vicki, the three of us are the only ones that have cell phone insurance. Is that right? Wow. You don't have cell phone insurance, Geneva?
No.
Rebecca, no cell phone insurance for you? Okay. So why don't you have cell phone insurance, Geneva?
Because I take care of my stuff.
What do you think about me?
I believe it's a waste of money.
Okay, so there's a couple of things there. She believes it's a waste of money. So you're willing to assume the losses because you think the premium is a waste of money, yes or no?
Yes.
Yeah, so loss retention makes sense when these conditions exist. So the first one is that she's willing to assume the losses, right? Assume the losses.
After this call, I'm going to drop my phone and destroy
Anyway, damn it, I should have bought insurance. We're not going to manifest that for you.
No.
So, if you're willing to assume the losses, that's about willing. So willing to assume the losses, that makes sense to retain it, right? The other one is that she said, what did you say before? You said
it was a waste of money, or that I take care of my stuff.
You take care of your stuff.
Mm-hmm.
So if you take care of your stuff, then you losses are predictable, right?
Yes.
Now they're predictable to the extent that she's protecting her phone and she's taking care of it. And then the other reason that someone will retain a risk is because the losses are minimal. So sometimes it makes sense to retain the risk when the losses are minimal. An example of where we see that, right, losses are minimal, is in the form of a deductible. You may have a deductible in your health insurance plan. You may find a deductible in your auto insurance policy. And the deductible is the amount of the loss that you're willing to bear before the insurance company pays. And there's an inverse relationship between the premium and the deductible. So the more of the risk that you're willing to retain, because loss retention means you're keeping the risk, right? So the more of the risk that you're willing to retain, what relationship does it have to the premium?
It lowers.
It lowers the premium. There's this inverse relationship. The more of the risk that I'm willing to bear, then the lower the premium. So if I want a low risk deductible, if I want a low deductible, what happens to the premium?
It goes
It's going to be higher because it means the company's going to pay out on the loss sooner. Does that make sense? And you see that in your auto insurance policies, right? You even see that in your health insurance policies. I'm going to introduce this real quick. We have, since the Affordable Care Act, we have these metal tiered plans that were established, right, back in 2014. And the 4 metal tiered plans, you all know your metals, don't you? Like, what's the lowest level of, what's the lowest metal is what? Bronze, right?
Bronze.
And then bronze, then we have what?
Silver?
Silver, and then go for the
Platinum.
gold, and then
Gold,
platinum. Platinum is highest. So if we look at the deductible, bronze has a high deductible, and the deductible for a bronze plan is $6,300. That's the deductible for a bronze plan. If you go up to platinum, platinum has no deductible. So which one has a higher premium, bronze or platinum?
Platinum.
Platinum, because it has more coverage to it. It's a 90, so it's going to provide 90% of the coverage, and whereas a bronze is 60/40, and there's a $6,300 deductible on that. Now, you do need to know the metal tiered plans, and you need to know the number that goes with the metal tiered plans as far as the level of coverage that it provides. So you can do it forwards or backwards, whichever way you want, but bronze is the lowest level of coverage at 60%, and then we go 10% every metal tier up, right? So if bronze is 60, then silver is what?
70.
70, gold is
80.
And then platinum is
90.
90. So you do definitely need to know the metal tier plans and the level of coverage that they provide. Do you need to know the specifics of the deductible? No. But I do emphasize that bronze has a $6,300 deductible just to demonstrate, like, wow, the premium might be lower, but look at that. If the insured gets sick or ends up in the hospital, then they're going to bear the first $6,300 in medical expenses under a bronze plan. All right. Again, what they're willing to assume. What they're willing to assume is the deductible amount. Now, under what conditions would one not retain the risk? When would one not retain the loss?
If something is of high value,
That's true. That's true. If the risk is high, you're definitely not going to want to retain it. What we're looking for specifically, though, is if the risk is unknown. That's the key word. If the risk is unknown, it doesn't make sense to retain it. If you don't know what the potential for loss is going to be, you're not going to retain it. You're going to find other ways to manage the risk. So, like, for example, getting into this career, right? There's an element of retaining the risk, and then there's an element of transferring the risk, which leads us into sharing. So sharing is a combination of two risk management techniques. Sharing is both transfer and retention. The two together make up sharing. The two together make up sharing. So, what does that mean? So I mentioned that if you're getting into this career and you're starting your own practice, right? So with that being said, you're investing your time, energy, and resources in this career, right? You're retaining that. That's your investment. But one of the cool things about this career is that you're in business for yourself and not by yourself. And that not by yourself piece of it is that transfer piece. Because both the insurance company and you are investing your time, energy, and resources into this newfound career. Does that make sense? You're sharing in this unknown risk. But it wouldn't make sense for you to jump into a risk when it's unknown. If there's an element or piece that you know and that you can mitigate, you're no longer taking an unknown risk. You're actually using all other methods of managing a risk when you face that risk. Because see, there's two types of risk. We didn't talk about this, but there's two types of risk. We have a pure risk, and then there's a speculative risk. A pure risk results into what? There's a result of loss or no loss. And pure risk is the only type of risk that's insurable. But the speculative risk results in what?
a greater chance of loss.
Loss or
Gain.
gain. Ooh, that's sexy, right? The gain part. So it results in loss or gain. So getting into this career, right, there's a potential of loss or gain. You don't know what the outcome's going to be, but you're investing your time and energy, and so is the company that you're working with is investing their time and energy as well to train you. I don't have the numbers off top of mind anymore, but I read somewhere insurance companies invest literally millions and millions of dollars to train their people so that they can deliver the product and offer the product to the public and make sure that their clients are taken care of and well protected, right? That's part of your agency relationship to the company. In the agency relationship between the insurer and the agent is this degree of obligation that they're going to train you, right? That they're going to not only train you, but they're going to pay you what they say they're going to pay you, and they're going to let you know what you need to know in order to effectively offer the products to the public because you represent the company. So there's a level of commitment between both parties. They have a vested interest in making sure that you're successful. But just like in passing the exam the first time, you've got to do your part. Just like we do our part, you do your part. They do their part, you do your part. There's this constant exchange, right? Where you're retaining the risk and then you're transferring it when you're working with someone else or when someone else is doing the same level, making the same level of commitment or investment that you are. We have risk everywhere. Everything that we do is a risk, right? I don't like to think about it because it could create a lot of anxiety if you think about every risk that we take. I mean, the moment you get into a car, there's a risk right there. And when you get into the car, that may result in loss or no loss. So no joke, sometimes I'll get to wherever I want to get to, and I'm like, yay, no loss, just because I teach this stuff and I try to keep it fresh in my head, right? But if you get into a car accident and you don't make it to where you intended to make it, guess what? I'm sorry, that's a loss, right? This career, loss or gain. Gambling, loss or gain. Investing, loss or gain, right? Cryptocurrency, loss or gain, loss. I'm sorry, just kidding. Just playing. But there's, again, everything that we do, there's an element of risk to it, right? There's an element of risk. But sharing is where you're keeping a part of it and then you're transferring another part of it. The way that you might see sharing in the insurance contract is you might see it as co-insurance. And the co-insurance is what I just was talking about when I was referencing the metal tiered plans under the Affordable Care Act. The metal tiered plans, the number assigned to each metal tiered plan is the co-insurance associated with that plan. So when you have a bronze plan, it's a 60-40 co-insurance. So the insurer pays how much?
40.
And insure 60-40. So the insurer
Oh,
pays
it's 60.
60, and then the insured pays
The 40.
40%. If we have let's go to gold. If we have gold, what does the insurer pay?
80%.
80%, and then the insured pays
20.
20%. So the co-insurance. Now, I pretty much spoke of these risk management techniques in a very broad scale, right? So let's be more specific about how like the insurance company would handle it. So let's say, for example, I took an application from a client back in 2001. He was in his early 30s. Now, think of the time period too, right? This was back in the early 2001 specifically. In his early 30s, had a heart attack at 28, but it was drug induced. He was relatively healthy. He was just a little bit on the heavier side. And his blood work came back with like some enzyme. I don't really know exactly what the enzyme was, but his liver was producing an enzyme, which, was a concern to the insurance company. And we had submitted an application for $1 million worth of coverage. How did the insurance company handle that from a risk management perspective? Did they share it, transfer, avoid, reduce, or retain that risk? How would they handle that?
Retain.
You think, okay, so Rebecca thinks retain. Anyone else? Vicky, what do you think? Would they retain it, transfer, avoid?
Transfer.
You think transfer? Okay, he's not that high of a risk. They wouldn't have transferred it. They didn't avoid it. They reduced it.
Reduce.
Yeah. The way that they reduced it is that they came back and they did not approve $1 million worth of coverage. They reduced it down to $500,000, and then they rated him on the premium.
And
Again, managing the risk. Pardon me, Rebecca?
and they did what? Rated him as what? Like sub?
Higher risk. Yeah, a substandard risk. Higher risk. Exactly. So again, these types of things will affect your insurability, right? He abused his body. He'd been drinking since he was 14 years old and then started doing drugs in his late teens. And so, that abuse on the body reflected in his health in his early 30s. Even though he had been clean, I think for like 6 years at that point, the damage to the body was still done. So of course, when we submitted the application, they did the health background or the health and the paramedical exam. Of course, it was going to come back as a higher risk because there was some damage done there with the liver, with that enzyme that was being produced. But he was still insurable. They were just going to charge him more and then reduce the amount of coverage that we had applied. Another one, let's say we have somebody who's really young and healthy. Their, blood work comes back, like they're super fit. They're within the BMI tables. How will the company handle that risk?
Super healthy risk.
They're going to
Yeah.
what?
Loss retention.
They're going to retain it. They're willing to assume. They'll take that risk. They'll take that risk every day, all day, right? Young and healthy, let's take them. Let's write all of them up. Why? Because what's the likelihood of them dying is later. I mean, everyone's going to die, but it's going to be later, right? So you're healthy and you're young, they're willing to take that type of risk. Your blood work comes back, you're in a low risk occupation, you have a healthy lifestyle, that's an acceptable risk. And they may even give you a discount. Because as far as risk classifications are concerned, you might have like a preferred, standard, substandard, but you might have a super preferred or an elite preferred, right? So super preferred or elite preferred, they're going to give you a bigger discount because you're going to be living longer and you're going to be paying premiums longer, right?
Would accidental death be covered in this policy?
You can add, yes, accidental death is covered in life insurance, and you can actually add an accidental death rider to your life insurance policy. When you
Because
add
if
that
you're
rider,
young,
say again?
if you're young, I think that's where you have the risk of dying, accident
In an accident,
or
you
suicide.
could. The cool thing about if adding the accidental death rider to your life insurance policy is that it will pay 2 times the face amount if the death is a direct result of the accident. If you have $1 million, or let's say $500,000 policy, you die as a direct result of the accident, guess what? They'll pay $1 million out for that.
But you have to die within the 90 days, don't you?
You do have to die within the 90 days, but it's another one of those things, Kaniva, where you need to read the contract. Because there might not be a time period on it, or there may be a time period on it, but you've got to read the policy. I heard a story on the Real Life Stories through the Life Foundation and life.org or lifehappens.org, and it was a really beautiful story. Well, not a beautiful story because somebody died, right? But the mother died in a car accident, or she had a car accident, ends up in the emergency room, gets better, and believe it or not, 2 years later, she dies. And in the death certificate, the cause of death were injury, death is a result of direct result of the injury sustained in a car accident. And so, and this was 2 years after the car accident. And how much did the policy pay? 2 times the face amount. So even though like in your study material, it says 90 days, could it be longer than 90 days? Sure. You got to read the contract. Anytime we mention numbers, the numbers that we talk about, you need to know for your exam. But could it be more liberal? Could it be more generous? Absolutely. Like, for example, there's a 2-year suicide exclusion. So if the insured's death is a direct result, or if the insured's death is a result of suicide, will the company pay? Not in the first 2 years. In the first 2 years, what the company will do is they will void the contract, act as if it never existed, and return the premiums paid. That relieves them of the liability of having to pay out the face amount. After 2 years, what happens if the insured's death is a result of suicide? Will the company pay or not pay?
Yeah.
They're going to pay. They have to pay because the suicide exclusion can be no more than 2 years. I've seen contracts with a 6-month suicide exclusion, a 1-year suicide exclusion. Can the company do that? Yes. Can the insurer put in a 5-year suicide exclusion? No, because it can be no more than how many years?
2 years.
So as long as it's more liberal and it's better for the client, the numbers that we talk about can be that, be more liberal, more generous. But they cannot be more restrictive in the benefit that they're giving to the client. Does that make sense?
Yeah.
So, and this is the difference between real world and test world and people who have experience. When people come into the classes that have experience, they run the risk of knowing too much. And then they see it through the lens of their company experience and their company policies. So you really got to keep a beginner's mind and keep an open mind with these numbers, because even when you're done with this class, you're getting a foundation, the groundwork in place, so you understand how these types of products work and how the how insurance works in a very generalized, broad paint stroke. Like I said, we go a mile wide and an inch deep. And then your companies are going to take you even deeper into how these products work, specifically for their products. Does that make sense? All right. Any questions about risk management? Now, there's one more thing I want to talk about. Let's see. Oh, we have 5 more minutes. Yes, I have enough time. And that has to do with reinsurance. So an insurance company, when an insurance company goes through the reinsurance process, this is more of the code and ethics, they're sharing. Now, why would a company reinsure? So reinsurance is where the insurer buys insurance on their own insurance products. Meaning that, for example, let's say that XYZ insurance company has a moratorium on homeowners insurance in the city of Dublin. Meaning they're not writing any new business, no new homeowner business policies are being issued in the city of Dublin. Why? Because they hold too much of the risk there. So because they hold too much of the risk, it may make sense for them to reinsure that line of business or that book of business in that area. So if there's some sort of fire that comes through the city, or better yet, Livermore, I think Livermore is a better demonstration of that, because Livermore has all those vineyards and there's a lot of open space. All of a sudden there's a fire that goes through Livermore. If you have one insurance company that holds all of the risk in Livermore, that could be a shock loss to the company. So one way to protect against that type of shock loss is to buy reinsurance. In buying reinsurance, once the losses exceed a certain amount, then guess what? The reinsurance company will come in and cover those losses. So the insurer may use reinsurance for one of 2 things, right? And other reasons as well. But the 2 main ones that you may see on your exam has to do with like insuring a line of business And the other one is if the insurer wants to write beyond their retention limit. What's it called? The what?
Retention
The retention limit. I ran out of space here, but this is the last thing we're going to talk about. So the retention limit is the maximum amount the insurer may write on any one policy. So if the insurance company's retention limit is 20 million, for example. Again, this is just a loose example, right? So if the retention limit for the insurer is 20 million, and Rebecca, we assess her needs and when all of the evaluation, we go through, you know, what she owes, what she needs to protect, how much she wants to leave her family, or replacing her loss of income. When we go through an evaluation, we come up with 25 million. But the insurer's retention limit is 20 million. Can we still take the application from her if she needs 25 million, but the company's retention limit is 20 million? Yes or no? Can give you the chance.
Yes.
Yes. Oh yeah, so I would take the application because what happens is that even though the retention limit for the company is 20 million, the insurer will reinsure the amount above the retention limit. So they'll go through the reinsurance process. Now, does Rebecca need to know that her policy is going through reinsurance? She doesn't need to know that. All she needs to know is that upon her death, the company will pay out how much? 25 million. Again, this is a way for the insurer to manage the risk because they're to write beyond their retention limit. So that when Rebecca passes, they'll pay the 25 million, and then that the insurance company will go to the reinsurer to make a claim on that 5 million that they reinsured above their retention. Does that make sense? I know I went through that really quick, but I mean that's pretty much the gist of it. All right. Do you have any other questions for me, Vicki? Any questions?
No.
Kineva?
No, no questions.
No. How about you, Rebecca? You're good? Okay, good. And Brad? Good?
It's just, what's the weekend homework?
The weekend homework. I love that you asked me that. Let me pull that up for all of you.
Sure.
Wrong phone. The weekend homework, from my recollection, I do remember that you're going to read the life-only quick notes and life-only exam 1 and 2. And then the chapters in the online training include, I'll tell you right now. Give me a second here. Let's see. Chapters 3, 4, and 5 for the online training from Lightspeed. And then the quick notes, life notes, and then the life only exam 1 and 2. So that's the weekend homework. And then you have my email tonight. I will send you the link to this video for today. And then I will send you the notes that I had mentioned for the classroom training, right, that I usually hand out. I'll give you those notes. And that will be helpful if you can print those notes and then bring them with you on Monday. Yeah, that would be helpful because you'll have something that you can actually draw the different policies on. Because on Monday, we're going to talk about the life insurance policies, and you'll have an opportunity to draw all of the different policies out. There's 10 questions on your exam that relates to the life insurance policy, so you definitely want to go over that. And yeah, and have a great weekend and get outside and stretch and breathe and, you know, go and have a good time. And then we'll get back to it with a double session on Monday. We'll have an AM session and then a PM session. All right, and you have access to my email, so if you have any questions, please feel free to email me. I probably check my email 2 or 3 times on the weekend, on Saturday and Sunday. So at some point, I may not get it right away, but I'll get to you before the end.